forward-looking statements that reflect the current views of Deutsche Telekom management with respect to future events. These forward-looking statements include statements with regard to the expected development of revenue, earnings, profits from operations, depreciation and amortization, cash flows, and personnel-related measures. You should consider them with caution. Such statements are subject to risks and uncertainties, most of which are difficult to predict and are generally beyond Deutsche Telekom's control. Among the factors that might influence our ability to achieve our objectives are the progress of our workforce reduction initiative and other cost-saving measures, and the impact of other significant strategic labor or business initiatives, including acquisitions, dispositions, and business combinations, and our network upgrade and expansion initiatives. In addition, stronger than expected competition, technological change, legal proceedings, and regulatory developments, among other factors, may have a material adverse effect on our costs and revenue development. Further, the economic downturn in our markets and changes in interest and currency exchange rates may also have an impact on our business development and the ability of financing on favorable conditions. Changes to our expectations concerning future cash flows may lead to impairment write-downs of assets carried at historical cost, which may materially affect our results at the group and operating segment levels. If these or other risks and uncertainties materialize, or if the assumptions underlining any of these statements prove incorrect, our actual performance may materially differ from the performance expressed or implied by forward-looking statements. We can offer no assurance that our estimates or expectations will be achieved. Without prejudice to existing obligations under capital market law, we do not assume any obligation to update forward-looking statements, to take new information or future events into account or otherwise. In addition to figures prepared in accordance with the IFRS, Deutsche Telekom also presents non-GAAP financial performance measures, including, among others, EBITDA, EBITDA margin, adjusted EBITDA margin, adjusted EBIT, adjusted net income, free cash flow, gross debt, and net debt. These non-GAAP measures should be considered in addition to, but not as a substitute for, the information prepared in accordance with IFRS. Non-GAAP financial performance measures are not subject to IFRS or any other generally accepted accounting principles. Other companies may define these terms in different ways.
Thank you for your attention. May I now hand you over to Mr. Stefan Eger.
Well, good afternoon and good morning to our listeners in the US. We're here to discuss our third quarter results with you, and I'm more than happy to have with me 3 members of our board, at least 2 existing and 1 future member of our board. We have with us René Obermann, hopefully shortly, our CEO, who is on his way down here, and we've got Tim Höttges, our group CFO, with us, and we've got also Thomas Dannenfeld with us, who's currently the CFO of our German operation, and he's the CFO incoming for the group from January 1st onwards. And Thomas would be obviously more than happy to also tackle some of the more detailed questions on the operating segment of Germany. And so, as always, I would suggest that we start with a quick introduction on our presentation, started by René and then followed after by Tim Höttges. And then about at halftime, we would be delighted to go into the Q&A, and both René and Tim will be happy to answer your questions. Having said that, I would like to hand over to René.
Thank you very much, Stefan. Good afternoon to all of you. Good morning in the US. The third quarter of 2013 at DT continued the positive momentum, which we already saw in our key markets in Germany and the US in the second quarter. First of all, we are satisfied with our operational performance, and particularly with the customer numbers in the second quarter. In the second quarter in a row, we won almost 1.3 million new postpaid customers, 152,000 new TV customers, and some broadband net adds, 21,000 in the group in Q3. Our revenues grew organically by 2.4%, which is a slight improvement versus the 2% in the second quarter. Both the EBITDA and the free cash flow in the quarter are also slightly ahead of capital market expectation, and they're fully in line with our full-year guidance. In Germany, we again delivered good results, particularly if you compare our results to competition who published this morning. We kept good traction in mobile, winning 470,000, of which more than 160,000 were under our own brand, new contract customers. And in fixed line, we got an additional 119,000 fiber customers in retail and wholesale combined. Revenues for the segment Germany were again solid, even though down by some 1.2%. But again, that's a very small decline, and we hope to keep improving that. The main positive driver was a better performance in our fixed network revenues, whereas mobile service revenues, ex-MTR cuts, came in slightly weaker at -1% underlying, thereby still significantly outperforming the overall market. On the profitability side, we performed very strong with an EBITDA margin close to 42%. In the States, we continued the very strong performance from the second quarter into the third quarter. You all saw the numbers from T-Mobile USA. In Q3, by over 1 million, of which 648,000 were branded postpaid net adds. And that's clearly the result of a continuous success of our Un-carrier consumer proposition. This is the second quarter in a row that we had more than 1 million net adds if you exclude the Metro PCS consolidation in Q2. The branded postpaid churn slightly up versus Q2, which is due to normal Q3 seasonality. However, year on year was reduced by 60 basis points to 1.7%. And that does reflect the improving customer quality and satisfaction at T-Mobile US. On the back of this strong result, we have now increased our forecast for branded postpaid net adds for the full year from 1 to 1.2 million to a now new range of 1.6 to 1.8 million customers. Revenues grew by 38% year on year, and organically, i.e. without the impact of the Metro consolidation, by 12.4% in the quarter. And service revenues at T-Mobile US have also improved significantly versus Q2. The trends here have improved significantly. Despite higher branded postpaid gross adds, the adjusted EBITDA at T-Mobile US grew year on year by 15% due to improving SAC and CPGA. Europe, in a still tough economic environment, we again delivered good customer numbers for our main growth areas, in particular, more than 100,000 new TV ads, 68,000 broadband ads, and 178,000 mobile contract net ads. Organic revenue trends improved, even though still somewhat negative, but they improved further in Q3 to -3.4%, whereas the organic adjusted EBITDA was affected by the changing revenue mix, as well as higher market invests in some of our countries. Please remember that we deconsolidated Hellasat as of April 1st and our Bulgarian business Globul and Germanos as of August 1st. Third point, system solutions. The order entry for T-Systems increased by almost 12% year on year to 1.8 billion, and the market unit returned to an organic growth rate of 2.7%, driven by the public area and large accounts. Overall, T-Systems revenues increased by 1.8%, also driven by the anticipated and flagged catch-up effect at Telekom IT. Organic revenue growth, excluding the impact of deconsolidated businesses and currency, would have been 5%. A significant improvement was also delivered on the EBITDA side, with the margin improving to almost 9% on the back of strict cost discipline and the conclusion of the cost intense transition and transformation phase in several of our big deals. A few brief remarks on our headline financials. Revenues and adjusted net profit grew for the first 9 months of 2013, with the revenue growth accelerating in Q3. The EBITDA decline almost halved versus the previous quarter, driven by a strong performance, particularly in Germany and system solutions. The free cash flow is clearly down for the quarter compared with an exceptionally free cash flow, which was strong in the third quarter last year. but it came in slightly ahead of capital market expectation, and we are really well on track to reach our full-year guidance of around 4.5 billion euro. And as flagged, our net debt clearly was reduced to below 40 billion euro from the Q2 peak. Since this is my last presentation to all of you of the quarterly results, and the next quarter will already be presented by Tim early 2014, I would like to thank you all very much for a very good a good communication and a good relationship. And I'm pretty sure that Deutsche Telekom, under the leadership of Tim, will continue to be very strong. Thank you very much, and hope to see you soon in a different environment. I think I'll miss you.
Thank you, René. You have never been so quick, by the way, 7 minutes. So with this, I'm just heading into the German business here. And very clearly, we are pleased with our operational and the financial performance in Germany in the third quarter. Revenues declined by 1.2% year-on-year. Our main positive driver were core fixed line revenues, which declined at 2.7%, thereby showing an improvement versus the previous quarters. The mobile service revenues declined underlying, including ex-MTR cuts by 1%, thereby still significantly outperforming the overall market. The slight iteration versus the second quarter is a result of the flagged intense competition as well as new EU roaming cuts in the summer and less visitor revenues being built specifically in Q3. We expect an improvement for the fourth quarter on the basis of what we are seeing so far. Wholesale revenues at -5% year-over-year were pretty much in line with the underlying trend of the second quarter. Adjusted for regulation, the underlying revenues were down by 4.7% year-over-year in the quarter. The adjusted EBITDA declined by 1.1% year-over-year, resulting in a strong margin of 41.9%. Main driver here was the OPEX reduction of almost 2% year-over-year despite rising personnel and energy costs. In German fixed, we saw all in all another satisfying quarter in line with previous quarter. I would like to highlight a few things. An improvement in line losses despite 21,000 LTE wireless broadband customers added in Q3. Continued strong growth of new fiber customers with 119,000 net new additions, of which 50,000 came from wholesale, driven by our contingent model, which is developing nicely. Broadband net adds were still negative at -47,000, burdened by the normal seasonal churn increase of the max tariffs of broadband customers coming up for renewal, a late start of our Entertain to Go product, and a slower start into the cooperation with Sky. This is clearly not satisfying, and we will tackle this with the following initiatives. First, push Entertain. We have to be more agile in promoting our new product features Entertain to Go. The Sky cooperation, after a slow start in August, is now running already on full speed. And an optimization of customer retention, as mentioned already at the Q2 results. And thirdly, as of 2014, an increased focus on VDSL and later on vectoring. Turning to mobile. The German mobile market service revenues decreased by 4.7% year-over-year in Q3, according to our market estimates. This is a clear deterioration versus the previous quarter. Despite us still outperforming the competition, our underlying service revenues in the quarter decreased slightly by 1% for the following reason. Intense competition, as already flagged at our Q2 results, new roaming cuts implemented in summer, SMS revenue decline accelerating to 30% year-over-year, significant lower visitor revenues built in Q3 versus Q2, and due to the seasonality and timing of the billing with other operators, this swift shift from one quarter to another can result in almost €10 million service revenue swing in one quarter. On the other hand, we had a very strong increase of almost 31% in our mobile data revenue, driven by the increased smartphone penetration and an increasing number of LTE customers with new data tariffs. By the end of Q3, we already had over 2.1 million LTE customers on our network, an increase of over 2 million year on year. Operationally, we continued our strong performance with 470,000 mobile contract net adds, of which 164,000 were own-branded net adds. A continued smartphone momentum with almost 1.2 million sales, including strong sales of Android and iOS devices, and the best-in-class contract churn at 1.1%. Coming to the US. We are very satisfied with another very strong quarter at TMUS, winning 648,000 branded postpaid net adds, an improvement of more than 1.1 million net adds versus last year. With 643,000 branded postpaid phones, net adds T-Mobile US led the US wireless industry again. Overall, we added more than 1 million of new customers with both prepay and wholesale net adds contributing positively to this number. In the third quarter alone, we sold 5.6 million smartphones, a new record at T-Mobile US, ending the quarter with over 16.5 million smartphone users, or 77% of the total base. As indicated, the branded postpaid churn increased slightly quarter over quarter, but the impact was much smaller than anticipated. Year over year, the churn rate declined by 60 bips to 1.7%, reflecting the improving customer quality at T-Mobile US. Let me give you some more KPIs on customer quality in the third quarter. We had 53% of our equipment installment plans receivables are regarded as prime, up from 43% by the year end 2012. The bad debt expenses decreased by 32% year over year, and the average application credit score is up 31% year over year. And importantly, the porting ratios against all major competitors in the market continues to be strong. The adjusted EBITDA increased year over year and quarter over quarter, also on a pro forma basis, despite the higher branded postpaid gross adds, mainly driven by improving SACs and CPGA trends. Please note that due to the different jump accounting under IFRS and US GAAP, there is quite a difference between the IFRS EBITDA and the US GAAP EBITDA, with IFRS being even higher. Branded postpaid ARPU decreased by 7.8% year over year due to the rapid customer shift to simple choice and value plans, which now count for already 61% of the branded postpaid base, up from 50% at the end of last quarter. The branded prepay ARPU continued to grow by 30% year over year and driven by the inclusion of the Metro PCS customers who have a higher ARPU. Let me provide you also with a bit of detail on the underlying development ex-Metro PCS in that quarter. Underlying T-Mobile US revenues, excluding the impact of the first-time consolidation of Metro PCS, increased by 12.4%, driven by stronger handset sales, but also a significant improvement in service revenue. However, also the underlying service revenues saw a significant improvement, declining by 4.8% versus 8.3% in Q2. This is a reflection of the better customer growth, offsetting the impact from the continuing migration to simple choice and value plans. Underlying EBITDA, excluding the impact of Metro, was down 16.7%. Again, driven by firing on all cylinders with our Un-carrier strategy and the strong customer growth. Let me give you an update on two of our core initiatives in the US, which were quite relevant for us during the course of the communication. The rollout of our LTE network and the Metro PCS integration. By the end of Q3, we already have covered 202 million POPs in 233 metro areas in the US, thereby achieving our initial 200 million POPs coverage goal 1 quarter earlier. We have modernized over 25,000 sites and cover already 91 of the top 100 markets in the US with our superfast LTE network. The Metro PCS integration also is ahead of plan. Our TMUS colleagues reflected this in their synergy outlook update for 2013 on Tuesday already. Network CapEx synergies are on track to beat plan by 200 to 250 million for May to December. OPEX synergies are on track to beat the plan by 50 to 100 million. And integration expenses, mostly CapEx here in this regard, are on track to beat plan by 100 to 125 million. We have launched 15 new metro markets with more than 1,300 distribution points in these markets by the end of Q3 under the so-called Apollo 15 program, and 4G LTE spectrum covering approximately 15% of Metro PCS network POPs will be refarmed by the end of 2013. On November 21st, T-Mobile plans to launch the Metro brand in 15 additional new markets, bring the total of expansion markets then already to 30, which is significantly above our original plan. Finally, let me also remind you that we were able to refinance $5.6 billion of the Deutsche Telekom debt in T-Mobile at attractive conditions on the debt market. This is another important step to transform T-Mobile into a self-funding platform. Let's move to Europe. Revenues in our European segment declined organically by 3.4% in Q3, the best performance since Q1 2012, by the way. The underlying decline, ex-deconsolidation, regulatory effects, foreign exchange, special taxes, consolidation and one-timers improved to minus 0.6%. The negative mobile regulation effects were driven mostly by Poland, Greece and the Netherlands. The decline in the traditional telco business, mainly voice and SMS, was partly compensated by higher device revenues, particularly in Poland, the Czech Republic and the Netherlands. Still, the single biggest negative impact for the Europe segment revenues came from Greece, with declines in the fixed and mobile voice business. However, underlying revenue trends actually sequentially increased in Greece, supported by significant trend improvements in fixed revenues as well as in mobile service revenues. Also, the operational performance was very strong in the quarter here in Greece. OTE TV reached 218,000 TV customers by the end of Q3, much above the original expectation. 12,000 retail broadband net adds, and an LTE coverage already reaching 50% of the POPs. The adjusted EBITDA in the segment fell stronger than in Q2, mainly driven by the following reasons. An increased market invest in Netherlands, which resulted in strong operational KPIs like 57,000 contract net adds, thereby again outperforming the incumbent, and a highly competitive market environment in the Czech Republic and Croatia, where the revenue decline couldn't be compensated sufficiently with cost savings yet. This is clearly not a satisfying performance, and we will have to work much harder on cost discipline in some of our countries, especially in Croatia, on the indirect costs in order to compensate for the difficult macroeconomic environment and the revenue shortfall. We continue to demonstrate good momentum in our growth areas in Europe, which is very important for us. We showed again good growth in TV with 110,000 net adds, now reaching almost 3.5 million TV customers, including newly consolidated 251,000 Digi TV customers in Slovakia. We delivered 68,000 broadband net adds in that quarter, mobile contract net adds of 178,000, and mobile data revenue growth accelerated again to almost 15%, excluding currency effects, thereby overcompensating the decline in SMS revenues. Let me give you again a quick update on the progress being made on the revenue as well as the technology and cost transformation in the segment Europe in that quarter. We made again progress on the revenue transformation. The share of total revenues from our growth areas increased by 3 percentage points year-over-year to 22 now. The share of the fixed revenues from Connected Home grew by 0.6 percentage points year-over-year to 21%, driven by TV revenues. The share of mobile data revenues of overall mobile revenues grew by 3 percentage points to 17%, and the share of B2B ICT revenues as of total revenues increased by 0.4 percentage points to almost 3%. Progress on the cost and efficiencies side included the all-IP share of all fixed network access lines grew by 10 percentage points to 26%, mainly driven by Croatia, Slovakia, and Hungary. LTE sites in service more than tripled year-over-year to 2,800. We have LTE networks in commercial use now in 6 countries already. And homes connected with fiber to the home grew by 33% year-over-year to around 160,000. And the number of full-time employees was reduced by almost 7% year-over-year to 55,000, which however included the deconsolidation of the Bulgarian business with 1,900 people. So what you could see is we are very focused working on improving our situation in Europe. Turning to System Solutions, Q3 results showed some solid improvements. The revenue increase of 1.8% was driven by the return to organic revenue growth of 2.7% at the market unit and the expected and flagged catch-up at Telekom IT. Order entry was strong, up almost 12% to 1.8 billion. Also, the adjusted EBITDA and EBIT showed a continued improvement driven by successful efficiency measures and the conclusion of the cost-intensive transition and transformation phase in several of our big deals. The EBIT margin of System Solution improved to 2.3% in the quarter, the EBIT margin of the market unit to 3.8%. As planned and communicated, Telekom IT delivers on reducing the IT cost. For the first 9 months, the IT spend was reduced here internally at Deutsche Telekom by 250 million euros. Let's move now to the group financials and turning to free cash flow. Actual free cash flow at 1.4 billion euros is down compared to last year. Main drivers here were cash generated from operations declining stronger than the EBITDA due to the working capital impact of 500 million euros, mainly from the value plans in the US. A cash capex increase of 350 million, driven by the LTE network rollout in the US. And the adjusted net income decreased by 11.4% year-over-year in the quarter, with the main drivers being a declining financial result driven by currency translation and the valuation of financial instruments, as well as the interest being impacted by the high yield debt of Metro. And a tax increase versus the low tax rate in Q3 2012 following the unwinding of T-Mobile US as asset held for sale at that point in time. Compared to the negative return on capital employed in Q3 2012, as a result of the impairment at T-Mobile US, we saw a good improvement for the group return on capital employed to 5.1% at the end of Q3, driven by a significant improvement of the NOPAT, net operating profit after tax, year over year after the impairment last year. A decrease of the net operating assets on average by 6.2 billion euros. Earnings per share improved as well, slightly year over year by almost 2% to 55 cents, with the main drivers being the well-flagged lower depreciation and amortization in our business. As flagged and expected, the free cash flow in the third quarter and the sale of the Bulgarian asset Globul and Germanos led to a sequential reduction of the net debt to again below 40 billion euros. The 492 million euro other position included 200 million euro dividend payments to minorities and 107 million euro spectrum payment in Poland. Turning to our balance sheet ratio, net debt to adjusted EBITDA decreased again slightly to 2.3 times as a result of reduction of the net debt. The equity ratio also improved to 27.8 due to the slightly lower asset base and the increased shareholders' equity. With regard to our comfort zone ratios, we are in the green with regard to all ratios, and our rating remains stable at BBB+ level with the major agencies and stable outlooks. As a result, we continue to get excellent funding conditions in the debt capital markets. And as we already said, we confirm our guidance on all items laid out. With this, René and I are now ready for your questions.
Thank you very much, Tim. Now we start with the Q&A part, just about half time as I promised. If you'd like to ask a question, please press *1 on your touch-tone telephone. The operator will announce your name and then it's your turn to ask a question. And then you should require to cancel the question, please press the #sign. Please restrict yourself to 1 or 2 questions to get through to as many questions as possible. Thank you.
First is Mr. Robin Bienenstock from Bernstein. May we have your question, please?
Yeah, hello, thanks very much, and congratulations, René, and nice to see that at your last set of results, the share price is at a more reasonable place. 2 questions, if I may. First, I'd like to know what you think about Spark and its ability to restore Sprint's competitiveness in the U.S. And separately, I'd like to know a little bit about what you think about the necessity of FTTH in Germany, given that vectoring and pair bonding and GFast seem increasingly to be offering faster speeds and reasonably reliable ones. I'm just wondering if you have any new thoughts on that. Thanks very much.
Okay, on the first part, Robin, thanks, by the way, for the appreciation. On the first part, I don't think I should talk about this new reselling model there. I think it's something you should talk to John about. He probably has also more insight into this competitive impact than I have, and I also shouldn't talk about T-Mobile US in that level here. For Germany, the current situation is really FTTH is not that aggressively sold yet. VDSL is meeting much better acceptance than FTTH so far. So customers' readiness or the private customers' needs seem not yet as developed that people are really crying out. Many people are crying out for FTTH. I think most people are happy when they have like 16 megabit and beyond. With 50 megabit, we can currently serve, most needs of customers. Yes, there are some exceptions, but the majority is really still fine with it. This will change over time, over the next couple of years. So we are well advised to keep building it out and, from a VDSL, well-built-out VDSL network, take the next step then, but not at this point in time. It's not such a big problem yet.
Let me add one point. Robin, definitely we are working on all, let's say, ways to improve the speed for our customers. On the mobile side, it is on the handset side, it is Cat 4 and even Cat 6. We have MIMO as one technology which we test in the field. And on the fixed line side, we have now the vectoring, which is under deployment, which is coming. We even know about, let's say, G.fast as one technology which brings the fiber even closer to the households. I think if we would only focus on FTTH at that point in time, it would take too long, by the way, to get a high propagation across our customer base. So the fastest and most effective way is now moving the fiber more and more closer to the customer, and that is what we are doing. And by the way, with full speed next year, everything is under preparation. Even our hybrid routing services. So that is, let's say, the plan, and I think that is absolutely the right thing to do.
Mr. Jonathan Dunn from Barclays, may we have your question, please?
Oh, hi there. It's just one question from me. At the end of the T-Mobile call, it became clear that they filed to raise debt or equity. As T-Mobile's biggest shareholder, can you just update us with your thoughts?
Look, this is Tim here. I think this is absolutely consistent with what public company peers are doing. The T-Mobile is filing S3 shelf registration statement to facilitate potential access of the capital markets in the future. That is what we're looking for. On the debt side, we always said, it should be a self-funding business. So they should carry with their debts on their own. And the second one, when it comes to the equity side, the question is, if there might be, opportunities upcoming with regard to spectrum, this might occur, which we then going to be able to refinance from a standalone perspective.
Mr. Justin Fanel from Credit Suisse, may we have your question, please?
Thank you. Yes, back to Germany. Two sort of topics, really. The first is again the pricing question. Liberty Global seem to be trying to lead the market up on price and talked about that as really a medium-term strategy. We'd like to move the market more into business more into more of a mix of market share and price increasing. It's a question I've asked a few times now. I'm just wondering how your thinking is evolving in this area. And any comments on the recent court's decision that the change in the contracts on data caps might be not legal in the view of that court? And secondly, any more update on the all-IP strategy in Germany? When could you start actually moving lines over to all-IP and start to get the cost savings from that, please?
Okay, let me start with this court decision. I think there is an opportunity in there because, first of all, it's not that data caps are illegal. It's just that the court has ruled that flat rates in fixed line need to be either flat or they are not allowed to be called flat rates. And customers need to be provided more clarity. And quite frankly, we look at this we look at this from a customer point of view and try to figure out where the opportunities are in there, because it's not just us being affected, it's the entire industry. And if you think about it, I think it can provide guidelines to redesign not only tariffs, but more importantly, the marketing programs around it. And ultimately, I don't think it is possible to provide ever more capacity in volume, data volume, and speed for ever lower prices. But it may well be that tariff names and product names are being restructured, And ultimately, customers will be provided more clarity, but not just from Telekom, but from the entire industry. So I think there is an opportunity in there. We haven't yet published our final answer, but amongst us here, and we're clearly a small group of people, only 100 people on the call, we are not necessarily challenging this decision. We will probably turn it into a marketing opportunity, but soon more details.
Your
Thomas?
question with regard to Liberty Global and their attempt in Germany. First, what you always, should take into consideration is that the cable operators are today more expensive for the end customer than our proposition. Because our proposition is fully integrated already. It's one price, while they have even, an additional fee, which is paid to the landlord. That is something we expect. The second thing is, I think what the cable operators are facing is the build out which we are doing, even especially in their areas. And what they even see is that we are coming with more attractive offers as well in this triple and even potentially in the quadruple play area. So therefore, I would not be so worried about the attempt. They definitely have to do something future-wise, but don't forget, even these guys have to earn back their capital costs and the money which has been paid. So therefore, I'm not worried. The opposite, we are quite confident that with vectoring and with what we are delivering in this areas where we cannot compete today, that we are quite competitive and quite strong.
Good afternoon. This is Thomas Dannenfeld speaking. On the third question, it was update on All IP in Germany. I think first it is important to notice again that All IP is a very important element for our network transformation to move over into a much leaner, more agile and efficient infrastructure. So that's really important for us in terms of transformation of the company. Detailed figures in Germany, we're expecting for this year roughly 1.5 million customers, consumer customers being migrated on IP, and also speeding up, by the way, in the next year to do as fast as possible migration of the customers and come to that leaner and more agile infrastructure. Cost savings, unfortunately, before you see that cost savings, you need to invest. That's what we're doing right now to migrate the customers. You need to add costs here by switching customers, by putting the right network infrastructure in place. So for the time being, what we do see is not a cost saving, but an increase of costs embedded in the figures you see right now. And obviously, we're doing that to gain cost savings then on a midterm perspective.
Mr. Polo Chung from UBS, may we have your question, please?
Yeah, hi. Actually, I've got two questions. So the first one is on T-Mobile US. Strategically, is T-Mobile US core to the group, or would you consider crystallizing the value and selling down? Because if you look at what you've done by selling down the T-Mobile intercompany debt with T-Mobile making that shelf filing, doesn't this give you more flexibility for M&A? So that's the first question. And the second question is really on German mobile. Your guidance implies flat mobile service revenues in Q4. So I'm just trying to understand the moving parts that give you the confidence that service revenue growth can recover in Q4 in Germany. Thanks.
This is Thomas again. I think I start with the second question, and then Tim might take over already. Let me be clear, first of all, in terms of the guidance in terms of mobile service revenues. It's not about Q4 being flat, but it's about the overall year being flat. That's our guidance underlying across the whole year. So that means a more positive development in Q4 as well, but the guidance is not on Q4, it's the overall year. And as Tim mentioned already in his short speech, we see some seasonalities in here, especially on the visitor side, but nothing we are worried about. So we are extremely confident that based on the huge differentiation we see right now in terms of network quality on one hand, that's what we see in all the tests being performed by third parties in the marketplace, but as well as on the service side, the differentiation takes place, the customers are being convinced. Churn is in a very, very positive position here. So we are very convinced that we can get to that mobile service revenue flattening across the year based on that.
Look, with regard to the shelf registration here, I think I said that it's consistent with the public company peers here. What we are doing. Never forget, we even have a lockup period for our stock here. So if you bet on that one, coming back to your strategy, our strategy in the US. Look, we started 1 year ago with a market share of $15.60 in the US market, developing it with a great management, with a great new marketing story, with huge investment into LTE build out, and even a good handset lineup into very value creation story. And if you would take the $22 billion and take the $18.2 billion on top of that, this company is from an enterprise value in the vicinity of 40 billion. Just remember that is the value which we had when we talked about the AT&T deal at that point in time. Our story is driven value creation in the US. That is, let's say, the story we are talking about, and that is, let's say, what we are bringing forward. We have sufficient capacity at that point in time. We have sufficient megahertz per pop for our current market approach in the US situation, and therefore our story is about value creation in the US. We always have said that on a mid to long-term perspective, this market needs more consolidation in the US. When it comes to additional capacity, and we see the bifurcation in that market from AT&T and Verizon being very strong in their footprint. So if there is the opportunity and the possibility for a consolidation in the mid and long-term perspective, we always said, that we are open for this.
Mr. Ryan Fox from Morgan Stanley, your line is open.
Thanks. I've got two questions. Firstly, on Germany and on margins in the domestic business. You said that OPEX was down 2% year on year. Could you please give some more color on the moving parts here and how much scope there is for further OPEX reductions going forward? And secondly, just on the group strategy, could you please give an update on how the review process is going for Everything Everywhere and Scout 24? Thanks very much.
I'm going to start with the EE question. And look, the first thing is we are very satisfied and happy with the development in the UK. Just remember where we are coming from as Deutsche Telekom with a let's say more or less stranded asset on the number 4 position in the UK market, and now being the market leader. Just this week, a very prominent drive test voted us number 1 in the London area for the first time in history. So therefore, our LTE build out is paying off. We have more than 1 million customers. Then the next follower on this 4G services here, and what you even have seen is that we are working very hard on further cost reductions to improve the margin in this market. And over the last quarters, we were quite successful on that one. That said, we said this business is under strategic evaluation because we have 2 shareholders here sitting on that business, and it is a value creation story here as well. Do we have to sell the business? Do we have to IPO the business? No. It's a question: what is the best time for creating value out of this entity? And that is something which is under observation together with our shareholders. There is no must-sell situation for Deutsche Telekom. We are following on the situation. I could say this year nothing is going to happen on EE. With regard to next year, we will decide on the operational performance of that business, and we will even decide on the windows in the markets. We might see whether we consider any kind of strategic step for our UK business.
On the first question around the Germany margins, we said last year in December in the Capital Market Days that we want to achieve a margin around 40%. I think we're doing pretty well so far. And obviously, looking at the OPEX, the main focus area for us is the indirect OPEX. It's not the direct OPEX, just to cut down market investment. Easy one, but unfortunately not on the long run the right way to do it. So it's about the indirect OPEX, and we do know that, especially looking at topics like energy tax and all that kind of stuff, where we see increases, we need to push forward in all the areas where we can really improve. But that's what we've done so in the last quarter as well. For instance, in areas like logistics, like platform efficiencies and all that kind of stuff. And this were some areas where we've been very successful to compensate that kind of increases in the indirect OPEX. So, but again, basically it's about keeping the margin around that 40% level. And I think that's working well so far.
There was one missing part in my answer with regard to the Scout business. Let me say it this way. I hope that Deutsche Telekom and its team here deserves some credit for M&A activities. I think we should not put ourselves under pressure. We have said, we have this strategic evaluation. There was a lot of noise in the market with regard to a potential sale of the business. Yes, definitely we are in discussion with partners on that one, but we do this kind of negotiations under values and not under any kind of timing constraints. And therefore, it is moving in the right direction, and I hope to inform you shortly on the next steps here.
Mr. Ottavio Adorisio from Societe Generale, may we have your question, please?
Hi, good afternoon. It's Ottavio Adorisio from Societe Generale. A couple of questions. The first is on cash, and the second is on European operations. The one on cash, you basically stated that the rationale to dispose T-Mobile debt was to make the asset self-financing. So the question is that what do you do with the liquidity, given the low return on cash and the fact that you have enough liquidity to finance debt maturity, as you stated in this slide number 18? And moving to Europe, in recent quarter, trends in European operations have partly negated the improvements you recorded in Germany and the US. Now, most of these operations were acquired a long time ago, and I was wondering if you still consider all these operations as core, and given a rising appetite for telco assets, would you consider at some stage to carry a review of the asset portfolio in Europe to assess amortization through asset sales might generate more value than the current status quo? Thanks.
Look, I think I understand your question such that you are asking whether we would dispose of European assets. And, the answer is that we have made it clear that over time we look at each portfolio item with regards to potential ROCE improvement or the need of ROCE improvement. But this is not to say that we look at things only short term. We're in the infrastructure business. And particularly in those markets where we have strong position already, at some stage the economic crisis may improve, and then we will emerge from the crisis as a much stronger player, particularly in those markets where we are both in fixed line and in wireless, and where we have significant shares. But anything else would lead into some speculation, which I would not want to trigger. But the one thing you can be certain is we look at portfolio items, with a view to over time improve its return on capital, and each item has an obligation to improve, which is not yet satisfying. It has to improve.
Let me answer your question with regard to the T-Mobile US. And by the way, it's even not a US-specific question. It's even a philosophical question with regard to Deutsche Telekom's approach towards these things. Remember OTE. We have said, we have minority shareholders in that business, and it should mean that an OTE is sacrificing its refinancing cost by asking the headquarters to do this. Therefore, we pushed OTA that time to improve their cash position, to sell non-core assets, as they did on Serbia, with Bulgarian, with Germanos in the satellite business, and that at the end of the day, OTA is today a fully refinanced business on a standalone perspective. The same holds true for the T-Mobile US business. And we always said our strategy is self-funding and de-risking. And therefore, we have said, look, guys, at the time of the business combination, it wasn't not reasonable for T-Mobile US to fund $11.2 billion in the high-yield market. So we gave T-Mobile US some time to gain traction in the market, to build the credibility and even the professionalism around that one. And now the US high-yield market is in a very good shape. And we tapped that market with this 5.6 billion notes, doing exactly what we always have said. A self-financing platform in the US and de-risking of DT. This is the way going forward, and this was executed. So I hope you understand a little bit of that philosophy of what we've done and why we did it. And I think it is good that the US business feels the pressure, from the investments and from the operational framework in which they're working.
And just, Ottavio, for clarification, there is no liquidity inflow in that sense. The net debt doesn't change at all on the DT level. So that's not that we now have 5.6 billion cash inflow at DT, which we would then have to look at what to do with that. That's maybe for clarification. Let's move on.
Mr. Tim Boddy from Goldman Sachs. May we have your question, please?
Yes, thanks. I wanted to ask a bit more about broadband in Germany, where obviously there was a slightly weaker trend this quarter. Could you talk a bit about your market share in broadband within the cable footprint compared to outside the cable footprint? And it would also be really helpful to understand whether you're seeing much better share trends in areas where you've already rolled out VDSL, or whether there's not a material difference. And then just switching gears slightly, talking about the Netherlands, you obviously decided to do an MVNO partnership with Tele2. Clearly, MVNOs have been, should we say, arguably contributed to a lot of the pressures the mobile industry is seeing in a number of markets. Can you talk about your decision to offer that MVNO? Thanks very much.
I'll start with the first question in terms of broadband in Germany. Yes, there is a difference in terms of the market share within the cable footprint and outside, but it's not a huge difference. It's a small and slight difference. I think what we do see looking at our Q3 figures, we have that kind of natural seasonality, not natural, but seasonality we see every year in Q3 a little bit. And as Tim mentioned already, some activities undertaken to change the numbers and bring them upwards again in terms of product attractiveness, in terms of promotional activity. But I think the most important one is the integrated network strategy. That's the strategy which in a very fast way enable ourselves to offer higher bandwidth, be it by mobile or by fixed line or by a combination, as we call it, hybrid. So that's what René said already, along that line of a slight increase, but an increase of demand in terms of bandwidth, not talking about hundreds of megabits like FTTH, but what we can offer in the integrated network strategy. That is what we see, and that is why the VDSL areas, why we improve there in terms of the gross adds and the net adds. So we think it's the right time now to foster that areas and to roll out as fast as we can. That's what we will do. So we'll see this year another 1 million, roughly, households being supported by VDSL, and a strong uptake within the year 2014 and 15, as announced last year in the Capital Market Days.
Yeah, I think if you take a step back and look at the overall market, and I think it's clear that cable has now grown by about 200,000, if I'm not mistaken, year on year, and they are now at 4 point some million connections, whilst we are at 12.4 million. So overall, we're still very strong in the market, and we're improving from somewhat 40% VDSL coverage to 65% VDSL coverage. That means in all those areas where we have VDSL, and then coupled with vectoring even, we're highly competitive. And if you look at the overall package we're offering, from installation to customer care to, value-add services with our Sky and so forth packages, I think we're very competitive. And therefore, overall, our market strength will continue, and I believe we can fight cable very effectively.
Agree. Let me answer the question on Tele2. In August 2013, we signed an agreement to share antenna sites in the Netherlands for 10 years. And we extended the existing MVNO roaming agreement for 2G and 3G for a period of 5 years. Now, you might question why we're doing that. This is a high competitive market. This is, let's say, a market where our return on capital employed isn't satisfying. This is a market where scale matters from a cost perspective, and whatever we could save is possible to improve, let's say, from a competitiveness or even from a network coverage perspective. With these deals, our first estimations show that a successful passive network sharing can result in potential benefits accounting for almost 30% of site cost over a 10-year period. I think this is quite significant from the economic perspective, and that's the reason that we went into this Tele2 transaction.
Mr. Dominic Klarmann from HSBC, your line is open.
Oh, yeah, thank you. Firstly, on regulation and the European Single Market Package, I understand the industry is currently in discussions with Brussels about filling that draft with real tangible details. Now, I'm wondering how you would describe the dialogue at this stage. Is it constructive? Do you oppose it? And if so, what are the potential deal breakers in your view? And then secondly, on the fiber migration in Germany, do you have a target you're prepared to share with us in terms of fiber subscribers, say, end of next year? Looking at the 1.4 million you have today, is something like 2 million for end of next year a good, reasonable target, or are you even more aggressive than that? That'd be helpful. Thank you.
This is René speaking. Look, the EU, you know me for being critical vis-à-vis regulation since many years, and I must say that we are seeing some improvements in in the approach, but it's clearly still a mixed bag. There are some positive elements and there are some negative elements. Clearly negative is there are further attempts to cut into the revenue and profit pool of the industry, i.e. by cutting international calls and international roaming prices further. With regards to roaming, personally, I feel somewhat mixed. I still think, we should, as an industry, be more customer friendly, and over time that would pay back positively. But clearly, I consider it utmost, unnecessary to make further cuts into international calls. That just takes away potential revenues, which we could, need to reinvest. More on the positive side, though long term, are the ideas around spectrum. I think it's good to harmonize the spectrum approach across Europe in a very reasonable way. Also, the allowance of QoS, quality of service management, on the side of partnering with internet companies, as well as the confirmation of the intention to stabilize unbundled local loop fees to foster investments. So it's a mixed bag. The approval before April 2014 and the new election, before the new election of the European Parliament, seems ambitious. Generally speaking, I think the pressure on politicians to stimulate broadband investments is still growing, and you see some encouraging early thoughts, for instance, also in the what we are hearing from the German negotiations in the coalition with regards to their willingness to support broadband investments and the business environment for broadband investors. but let's wait for the final outcome. So it's a mixed bag. I'm slightly positive. I'm not enthusiastic, but I'm slightly positive, and I'm also positive about our future ability to compete with our VDSL/vectoring investment program.
Yeah, and based on that and adding to it the question about fiber migration in Germany, what I don't want to do is disclose now numbers for year-end 2014. We'll talk about 2014, I think, next quarter, first quarter next year. What we do and very aggressively do is what we announced last year in the Capital Market Days. We will spend roughly an additional 1 billion euro next year for the integrated network strategy. And I think that's very aggressive in terms of rolling out, and obviously then also looking out for the customers in the marketplace to make sure that we get a good utilization on that investment. Yeah.
The last question for today is coming from Mr. Frederic Boulan from Nomura. May we have your question, please?
Hi, good afternoon. Just two questions, please. Firstly, on Germany, talk a bit about what's happening on the fixed line side. We're seeing some small progress in terms of revenue performance. We are actually seeing a couple of incumbents now in Europe starting to grow fixed EBITDA or even revenues. So could you comment specifically on, in your case, considering the ramp up in VDSL plus vectoring, and the headwinds on line loss and broadband momentum, when do you think growth is possible? And secondly, just on your overall midterm guidance, so I know it's not the usual forum for that, but the guidance provided at the CMD last year is going for revenue growth and EBITDA growth in 2014. So if you could comment on how you feel about that, considering the current performance, and similar question for the 6 billion free cash flow guidance you have for 2015. Thank you very much.
First of all, kind of reflection on what you said about Capital Market Day. What we announced there is that we will see a stabilization in 2014 in the revenues, not a growth. Nevertheless, we would like to see a growth, don't get it wrong. But we said we committed to stabilize them. And part of that stabilization is and was to see in mobile a slight increase and growth on one hand in the service revenues, and B in the connected home revenues, an increase around 2%. That was what we guided for 2015 related to 2012, and we're still committed to do so. And this is why Tim mentioned a minute ago that we're doing some activities and measures here additionally to the integrated network strategy and the rollout we're doing there to keep the products attractive and make customers happy with the product.
Let me spend a sentence on 2013 and even on 2014. First, I think we're in a very good way to deliver on the 2013 targets, which we have laid out, the 4.5 billion and the 17.5 on the EBITDA side. So this is well on track, and we reiterate that we will do that. Even under higher customer growth number, which we're achieving in the US, because we could compensate that with better synergies and lower OPEX as we have laid out. So I think that is the first good message. This is a starting point then for 2014 and beyond. And what we see today is there is no reason nor any kind of news that what we have said on the Capital Markets Day, that we're going to change that. I think in principle, what we're seeing is a very strong growth momentum in our US operations, good track, unbroken from what we see, moving on in 2014. What we see is a stabilization almost, in our German environment, with, let's say, a leading position both on mobile and on fixed line in its markets, and let's say a good answer, even from a market perspective. We're doing well on the net add trends here, looking forward, and even from the network quality. And we have even a significant improved T-Systems business. Look at the numbers. We have an improvement of 18.5% on the EBITDA side. Even here, our OPEX and our CAPEX is much better under control. The more challenging environment is Europe. There is a lot of macroeconomic things which are hitting us, and even the regulators are here to a certain extent a little bit unreasonable. So therefore, we have to fight against that. We have to adapt our cost structure towards the revenue developments in these areas. And what we even have to do is that we focus on the areas where we could win. And this is why we're even stressing this in our presentations. And in the areas, being it TV, being it mobile data, being it the B2B area, in these areas, I think we made good progress. And that is for us, I think, a sign that in these difficult environments, we even find a way to fight back on the current trend. And with this, I think what we have said on the Capital Market Day stays the relevant KPIs, even for your orientation for the future.
Thanks, Tim. And that is basically the end of it of today's conference calls. I know that there were some key people still in the waiting line. You'll be called up in the next 15 to 20 minutes by myself and the IR department. In the case of any further questions from the ones who haven't handed in questions, please contact ourselves and the IR department. Thank you very much and speak to you soon. Bye-bye.